Well, if you've been anywhere near the financial news, or let's be honest, maybe anxiously refreshing your own crypto portfolio, then you know that today, August 25th, 2025, has been quite a roller coaster. It's been a day of really dramatic shifts in the digital asset world, particularly for the big ones like Bitcoin and Ethereum. We're looking at, well, a whirlwind of intense sell offs, massive liquidations, and just a rapidly shifting market sentiment. It's left a lot of people wondering what just happened. So our mission today is to cut through all that noise. We've been a deep dive into a stack of the latest articles, research, data, everything from the past few days. Our goal is for you to walk away understanding not just what's happening in these, well, pretty tumultuous markets, but crucially why it matters to you and maybe what implications these events might hold for the road ahead. Okay, so let's jump right into the immediate tremors shaking the market. If we look at the raw numbers from today, Bitcoin, BTC, it's been experiencing some truly significant drops. We've seen it trading in a range from about, let's see, $109,841 roughly, up to 112,934 USDT.
Right, and that USDT tether is pegged to the dollar, so we're talking real value shifts here.
Exactly. And that range reflects a decline of between, what, 1.85% and nearly 3% in just the last 24 hours. But the real headline grabber, perhaps, is Ethereum, ETH. It's down even more dramatically.
Yeah.
Trading around $4,369. That's a substantial 9.18% drop, though it's worth noting we saw it quoted earlier today, closer to $4,700 USDT. That was only a 2.34% decline before it really took a nosedive.
It fell off sharply later on.
Right. And overall, the ripple effect is clear. The total crypto market cap has decreased by about 2.4%, now standing at $3.96 trillion. And the total trading volume hit $187 billion. These aren't just minor dips. These are, well, significant market moves.
What's really striking here, I think, is that this isn't just your typical market fluctuation. We're witnessing what many analysts are actually calling a flash crash event.
A flash crash. Okay.
Yeah, that term refers to a really rapid, often unexpected, and severe price decline in a very short time. And to put it in perspective for you, it wasn't long ago, actually just back on August 13th. Bitcoin seemed almost unstoppable, right? It hit a recent peak of $124,496. Lots of talk about $150,000.
I remember that. Yeah. Felt like it was just going straight up.
Exactly. So today's levels mark its lowest point since July 10th. That's quite a reversal. And the sheer speed of this decline is particularly notable. We saw the price drop by nearly $4,000 within just minutes.
Wow.
Which, as you can imagine, triggers this cascade of automated selling across the market.
A drop of $4,000 in minutes? I mean, that's a gut punch for a lot of people. So that begs the question, what specific catalyst caused this sudden, really dramatic plunge? It sounds like there's a very specific kind of big story behind these numbers, not just general market jitters.
Absolutely. The primary factor appears to be a massive sell-off, orchestrated by a single, huge, long-term Bitcoin holder, someone referred to in the crypto world as a whale.
Right, the whales.
And a whale isn't just someone with a bit of Bitcoin. These are individuals or entities typically controlling, say, between 1,000 and 10,000 BTC. Their movements can genuinely sway the market because of the sheer volume they control.
Okay.
This particular trader, get this, had held 100,784 BTC for over 7 years.
7 years.
Yeah. To give you a sense of scale, that stash was initially worth about $642 million. Today, before the sell-off, it was valued at an astounding $11.4 billion.
Incredible.
So this whale moved to liquidate a significant portion, deposited $2.59 billion worth of BTC into Hyperliquid to sell. Other reports detail a single transaction selling 24,000 BTC, valued at $2.7 billion.
Just one sale.
One huge block hitting the market. That creates immense selling pressure, obviously.
That's a staggering amount of capital for one entity to control and then, well, unleash on the market. What does the action of a single massive holder like that actually mean for the broader market and, critically for the everyday investor watching this?
Yeah, this raises a really important question about market structure, doesn't it? Interestingly, on-chain data actually showed an all-time high of 2,000 active whale addresses just this August. So it signals maybe a broader trend of distribution amongst these big holders.
Yeah.
But the immediate consequences of such a flash crash, especially from one big sell-off, are pretty stark. It triggered over $30 million in liquidations of open positions.
Ouch.
Right. That's basically automated selling of leveraged trades. When a trader's collateral falls below a certain point, it forces them to close at a big loss. And across the Bitcoin and Ethereum derivatives markets, Roughly $3 billion in open interest was just wiped out.
3 billion.
Yep, that's the total value of outstanding derivative contracts. It shows a massive deleveraging event where speculative positions were just forced close. We saw 24-hour-long liquidations alone reaching $640 million. So you can really see the domino effect of one large sale. What's fascinating here, though, and you hear this sometimes, is an interesting counter perspective from some analysts.
Okay, what's that?
They argue that whale selling is healthy for the market in the long run.
Healthy. How is a crash healthy?
Well, it sounds counterintuitive, I know, especially if you're caught in the downturn. But the idea is the supply of Bitcoin held by these early, very large holders is finite, right?
Okay.
So for Bitcoin to mature and become fully monetized, meaning widely adopted, liquid that supply needs to eventually enter broader circulation. Their selling, well, definitely painful short term, is maybe required for the full monetization of Bitcoin. It redistributes the wealth, flushes out maybe over-leveraged players, and ultimately allows for more robust price discovery as more people hold the asset.
That's a different way to look at it. Painful medicine, maybe?
Something like that.
It's a really stark reminder that even in a system that's theoretically decentralized, you know, the concentration of wealth can create these very centralized points of impact. But what I find truly astonishing here, and this is where it gets really interesting, is that not all crypto behave the same way. Ethereum, in fact, has this fascinating, almost contradictory twist in the story. It turns out that very same whale who dumped all that Bitcoin actually used a significant chunk of those proceeds to buy Ethereum.
Interesting. Rotating funds.
Exactly. Specifically, 416,598 ETH was acquired. And then 275,500 of those tokens were staked, locked up to support the Ethereum network and earn rewards.
So not just buying, but staking, too. That's a longer-term play.
Right. And get this, despite the broader market chaos and Bitcoin's plunge, Ethereum actually hit a new all-time high, around $4,946, maybe $4,948, depending on the source, just recently, before its own sharp drop, of course.
Wow, a new high amidst the chaos.
Yeah. And that surge was largely attributed to strong ETF inflows and institutional buying. It suggests a very different kind of market sentiment was at play for ETH.
And if we connect this to the bigger picture, like you said, the ETF data, it really reviews a key divergence. It explains this contrasting behavior.
Okay, tell us about the ETF flows.
So U.S. Ethereum spot ETFs saw substantial inflows, $341.16 million just on Friday, August 22nd. Leading the charge were Fidelity and BlackRock, with $117.9 million and $109.37 million, respectively. Huge numbers.
That's serious institutional money flowing into ETH.
Exactly. It marked a significant green streak for ETH ETFs, showing really robust institutional demand. It seems institutions, seeing Ethereum's ongoing network upgrades, its role in DeFi, its staking yield potential, they appear increasingly confident in its long-term value. Maybe even using it as a hedge or diversification away from Bitcoin. Now, in stark contrast, during the same period, U.S. Bitcoin spot ETFs, major net outflows.
Outflows from Bitcoin ETF.
Big time. $1.17 billion flowed out from August 18th to August 22nd. Just on that Friday, August 22nd, they saw outflows of $23.15 million. And BlackRock's Bitcoin ETF alone faced the largest single outflow of $198.81 million.
Wow. So money leaving Bitcoin ETFs while pouring into Ethereum ETFs.
Precisely. It clearly indicates a significant shift in institutional capital, at least in that snapshot. Funds flowing out of Bitcoin into Ethereum. It suggests that even with its own short-term drop from that recent peak, Ethereum is showing maybe a greater resilience. It might even see a recovery sooner than Bitcoin because of this underlying institutional interest.
So the big money, the institutional players, clearly saw Ethereum as a strong bet or perhaps even a relative safe haven while getting out of Bitcoin, at least temporarily. But okay, beyond these direct market flows and, the actions of individual whales, there are even broader economic forces at play here, aren't there, shaping the very currents of this whole digital ocean. What else is influencing these market movements from a wider perspective?
Indeed. Yeah, it's crucial to broaden our lens here. From a technical analysis perspective, which many traders watch very closely, Bitcoin is showing several bearish signals right now.
Okay, like what?
Well, it's trading inside what's called a descending channel. That's a chart pattern indicating a sustained downtrend. It's also below the Ichimoku cloud. That's a complex indicator. But basically, being below it suggests strong bearish momentum.
Right.
And perhaps most notably for technical traders, it has formed a death cross.
Ooh, that sounds ominous. What is it?
It does sound bad, doesn't it? It's when Bitcoin's 50-day moving average crosses below its 200-day moving average. It's a classic technical signal, often interpreted as a precursor to potentially more significant price declines.
Okay.
So analysts are suggesting that if this bearish momentum keeps up, the price could fall further, maybe towards $105,400 or even $93,571. That $105,000 level is seen as a really critical support. If it breaks below that, things could get steeper. And what's truly fascinating here is how these technical signals kind of intertwine with the external macroeconomic forces.
Right, the bigger economy.
Exactly. Investors are keenly watching upcoming inflation data, particularly the personal consumption expenditures, or PCE index. That's due late August. This is the Federal Reserve's preferred measure of inflation, and its reading will heavily influence their next moves.
And the Fed's rate decision is coming up too, right?
Critical. As of mid-August, market expectations for a quarter-point rate cut in September were really high, like nearly 90%. There was this strong belief the Fed would start easing monetary policy.
Okay, so the market was largely pricing in a rate cut. But is that expectation holding up now, given everything?
Well, that's precisely the tension. Some analysts are now cautioning against, quote, overbidding on aggressive rate cut scenarios. They're noting that recent inflation data might not fully justify multiple cuts or cuts as aggressive as the market was hoping for.
Okay.
And Fed Chair Jerome Powell's speech on Friday, it kind of added to this complexity. Some are calling it mixed messaging. Well, while he did hint at potential September rate cuts, which the market liked, he also really stressed that the labor market is still in good shape, the economy remains resilient, and that ongoing changes in tax, trade, and immigration carry inherent risks of higher inflation down the line.
So saying cuts are possible, but also highlighting inflation risks.
Exactly. It creates this clear policy tug-of-war in the market. You've got potential rate cut tailwinds suggesting easier money, clashing with potential tariff-driven inflation risks that could force the Fed to stay hawkish or keep rates higher for longer. And this uncertainty from the very top of global finance, it inevitably casts a shadow over all risk assets, and that includes crypto.
Okay, that is a lot to digest. We've got whales, ETFs moving in opposite directions, technical warning signs, and the Federal Reserve sending mixed signals. So what does this all ultimately mean for someone just trying to understand and navigate this incredibly volatile market, especially given today's big moves? How should we frame this?
Yeah, it really raises that important question, doesn't it? Is this just another cyclical shakeup that crypto is kind of famous for? Or does it maybe signal something more profound for the market's fundamental health? I think it's crucial for you to remember the inherent volatility of this space. Bitcoin especially has seen these spectacular rises and gut-wrenching drops before. Many times.
True, it's part of its history.
It really is. Its price swings are a defining characteristic. They're deeply impacted by market sentiment, regulatory news, tech advancements, and when we compare it to traditional assets like stocks or bonds, Bitcoin just demonstrates significantly higher volatility. That highlights its unique, often thrilling, sure, but undeniably risky profile. However, and this is important, this volatility also feeds into the market's long-term resilience in a way.
How does that work?
Well, while definitely painful for investors short-term, these price drops can paradoxically lead to a healthier and more resilient ecosystem. How? By kind of filtering out speculative investments, the project's built mostly on hype rather than real substance, and leaving behind projects with solid fundamentals and real-world use cases. It's a natural, if sometimes brutal, process of market consolidation.
Survival of the fittest, crypto style?
You could say that. And historically, Bitcoin has demonstrated resilience to previous price drops. It recovers, it continues its upward trajectory over time. This isn't just luck. It's built on its inherent design, decentralized, immutable network, its robust network of miners and validators, and its growing adoption by both institutions and individuals. These kinds of events, these shakeups, they often lead to shifts in investor behavior too. They prompt more cautious investment strategies, more focus on diversification and risk management. It teaches the market crucial lessons, usually the hard way.
Okay, let's try and bring it all together then. So, in a nutshell, what stands out as the most critical takeaways from today's deep dive for you?
Right, to summarize the key takeaways from today, I think first we've seen this immediate, really dramatic plunge in Bitcoin, triggered by that significant whale sell-off, which then cascaded into a flash crash and widespread liquidations. A real shock to the system.
Definitely felt like a shock.
Yeah. And this happened even as we saw this contrasting resilience and even a new all-time high for Ethereum, fueled by those strong institutional ETF inflows. Though, of course, ETH also experienced its own sharp drop in the broader market downturn eventually.
Right, it wasn't totally immune.
No. And all of this is unfolding against this backdrop of complex macroeconomic uncertainties. These mixed signals from the Federal Reserve regarding
But
potential rate cuts versus those ongoing inflation risks.
thank you. It really does feel like a complex interplay of forces right now.
It really is. And if we connect this to the bigger picture, what today's deep dive truly illustrates for you is this constant, intricate interplay between individual actions like that whale, the collective psychology of the market, and these larger global economic forces, all happening in this still evolving world of digital assets. So maybe the final thought is this. Given Bitcoin's historical resilience through countless corrections and this emerging institutional interest in assets like Ethereum, how do these dramatic short-term events continually reshape the long-term narrative of digital assets? And what does this ongoing maturation, these growing pains, truly mean for the future of decentralized finance? Which, remember, is designed ultimately to be free from these kinds of concentrated points of control. It's a big question, and I think today's events highlight it more sharply than ever.